Hello friends, welcome to our next tutorial, that is risk analysis in the capital budgeting. Now we have seen what is capital budgeting in our last class, okay, and how do we work out the capital budgeting and how do we take decisions. Pretty simple, isn't it? There are only two things if you have to do the capital budgeting. One is the cash flow, another one is the discount rate. Now take the cash flow, discount it, and then apply the formula. The formula is present cash inflow minus present value of cash outflow. You will get the capital budgeting problem. Okay. Now, as I told you, this particular semester we are studying risk management and derivatives, which means we will apply a little bit of risk management in the capital budgeting decisions. Now, what are the risks that is involved while doing the capital budgeting problems, or what are the risks involved in the capital budgeting decisions? As I very clearly told you, there are two variables. Okay, the variable number one, the variable number one, cash flows we have to work out. What do we need to work out? Cash flows. Second thing, we need to work out the discount rate. Now, both these things so far in the examination, it is given in the problem itself. Now, how do we work out cash flow? How do we work out the discount? Technically, what is cash flow? Cash flow is nothing but our profit. Okay. What is discount rate? Discount rate is our cost of capital. Now, let's not go into detail. What is cost of capital? What is profit? How do we arrive at the profit? How do we arrive at the cost of capital? We will understand discount rate, because in the examination, they will very clearly tell you what is the discount rate and what is the cash flow. Okay. Now, as I told you, let us say tomorrow I buy a car. This car I'm planning to rent it out, let us say to the Uber. Now, this particular car, I'm expecting a cash flow of 50,000 rupees per month. Now, can I say with certainty that 15,000 I will earn next month? No. Why? Because it may be 45,000, or it may be 30,000, or it may be 25,000. If you are running the Uber vehicle, okay, it is not a fixed rent. So therefore, I cannot estimate the cash flow with certainty. But whereas if you look at my problem, all the problem that we would have done in your first semester as well as in the last tutorial, where cash flow was very clearly given. Okay, there was no aspect of risk component that was involved, which means where I can apply the probability. Okay, that is why both in working out the cost of capital, working out the profit, we may not with certainty tell in the future this is the cash flow that I will get. So therefore, what we do, we apply something called probability here. What is probability? For example, now if I am doing a business tomorrow, okay, with 1 lakh rupees capital, okay, next year I may earn 10,000 or I may earn 15,000. The probability of earning 15,000 is, let us say, 30%. The probability of earning 10,000 is 70%. How? Now, this probability we arrive at based on our past data or based on our industry comparison. Okay, so the whole idea of probability, if you have to work out, then you must understand lot of past data. Okay, now you don't need to worry, because in this examination they very clearly tell you what is the probability. Okay, so now you understand what is the risk. The risk means in estimating cash flow we might have done a wrong estimation of the cash flow. We must have done the wrong estimation of the cost of capital. Now this is what we call it as the risk. Why it is risk? Because if you estimate wrongly, which means your decision will be wrong. Okay. Now, what are the various, why these two variables can change? Okay. Why it will change? What is the reason for change? Okay. So that is why we study in this particular chapter what is the types of risk, and two, what is the source of risk. In the examination, they may ask you what is the type of risk and what is the source of risk. Okay. So let us learn what is the type of risk. As I very clearly tell you, there are three types of risk: standalone risk, portfolio risk, market risk. Now, what is this standalone risk? As I very clearly tell you, if you are estimating wrongly the cash flow, then it is called standalone risk. Now, what is a portfolio risk? What happens is, if you are investing in three assets, okay, if you are investing in three assets, in one asset you may get a good return, in another two asset you may get a less return. So what happens is, if you do not estimate all these three things correctly, if you are doing some 2-3 projects, then that is called portfolio risk. Now, what is market risk or beta risk? Okay, if your project is very much connected to some particular thing in the market, okay, then if the market changes, your asset return or expected cash flow also will change. For example, let us say if your project is dependent on government decisions, let us say you have taken a road project and this road project is based on the decision of the government. Okay, now if the government says, okay, tomorrow this project must be completed some x number of days, or this is the some condition they have given, a new government comes, the policy changes, and accordingly your risk also will change. Now these are the three types of risk. What are the three types of risk? Standalone risk, portfolio risk, and market risk. Now from where do we get all this risk? This risk we will get because of that particular project, because of competition, because of industry, because of international risk, and because of economic risk. Now, these are all various types of risk involved. Now, why we are studying all this risk? Because of these factors, that is the market factors. Market factor means inflation, change in interest rate, general economic conditions. Okay, this is what we call it as market risk. International forex risk. Okay, we call it as forex decision, international some decision. Because of that change, our cash flow gets affected. We call it as international risk. Industry specific risk, as I very clearly told you, in that particular industry some law changes, for example some technology changes, because of which your cash flow will get again affected. Okay, then if the competitor is coming out with a new product, okay, because of which your sales is getting affected, then that is called competition risk. Then if you are doing a particular specific project, okay, let us say if you are doing a mining, then there is a risk involved in the mining because you do not know very clearly how much cash flow you will generate. Now, these are the source of risk. What are the source of risk? Project risk, competition risk, economic risk, industry risk, and international risk. Finally, I'm only coming to only one point. What is the one point? If there is some change in the variables, okay, that is the economic variable, industry variable, something, if that changes, it affects these two. That is the cost of capital and as well as the profit. Now, if you understand those variables, these variables can be accordingly modified. Now, how do we do that? Now, in order to solve all these things, we use the concept of probability. Now, based on the probability, we have we have invented or we have arrived at some 5 methods to solve the problems in the capital budgeting. What are the 5 methods? Very simple. One is risk adjusted discount rate, certainty equivalent method, sensitivity analysis, probability distribution approach, decision tree approach. Now, these 5 methods in your examination, they may ask you out of this 5, two questions will be there. Okay, we will work out how to work out the risk adjusted discount rate, certainty method, sensitivity analysis, probability distribution approach, and decision tree approach. Now you may ask me, sir, what is this risk adjusted discount rate? Okay, now in all the problems for us, when a capital budgeting problem is given, the cost of capital, the cost of capital is, let's say, 10%. If it is given, okay, the cost of capital is 10%. If it is given, this cost of capital, whether some risk premium is adjusted to this cost of capital is what we have to see. So technically what we do is, okay, risk adjusted discount rate means, okay, see here, if you look at, I'm not touching the cash flow. Whatever I projected the cash flow will be the same. But only thing is, if there is a risk involved in this project, to that extent of the risk, I will change my cost of capital. In the cost of capital, if the risk adjusted discount rate is equal to, formula is like this: risk free rate plus risk premium. Now, what is this risk premium? Okay, in the examination, directly they will give you what is risk premium, what is risk free rate. What is risk free rate? Your bank deposit rate. Okay, if risk free rate is 10%, and for this particular project, if there is more risk, okay, let us say we will calculate 1 to 10, okay, if the risk is 1% or 10%, okay, let's say the premium is, let's say, 2%. If it is risk is 5%, that is 50%, then it will become 10% risk premium. So you don't need to work out, because they will not ask you to work out how to calculate the risk premium. Okay, that is not your job. The risk premium will be given in the examination. Let's say the risk premium is 3%, so risk adjusted discount rate is 13%. So all you need to know is only what do you mean by risk adjusted discount rate. A risk adjusted discount rate is nothing but a risk free rate plus risk premium. Now what is this risk adjusted discount rate? Is nothing but cost of capital. So they might directly give you in the examination, look, this is the cash flow, this is risk adjusted discount rate, apply the formula, so work out the problem, over. Okay, or they may give you risk free rate and they'll also give you risk premium. Then what you do, you just add up, then you will get the risk adjusted discount rate. Okay, but otherwise all remains the same. Yesterday, as I will clear you, if the cash flow is given, let us say the cash flow is 50,000 outflow, 0 year, 1 year, 2 year, 3 year, let us assume 20,000, 40,000, and let us say 30,000. This is the cash inflow. So what do you need to apply? Apply 13%. Okay, your discount rate 1. Okay, so apply 13%, then work out the discount rate, multiply. Okay, whatever the present value of cash flow you are getting, okay, then work out the problem, arrive at the answer. Then if it is positive, accept the project. Now that's all, very simple. Risk adjusted discount rate is nothing but risk free rate plus your risk premium. Very clear? So now we will work out one problem. Okay, the problem is, let me take up one problem, risk adjusted discount rate. Let's take this problem. An investment having an initial outlay of 1 lakh. It is expected to generate cash inflow as follows. Once again, I'll tell you, see, the cash flow outflow is 1 lakh and cash flow inflow for 4 years is 40, 50, 15,000 and 30,000. What is the risk-free interest rate? 10%. What's the risk premium? 10%. Okay. So they are asking you to calculate risk-free rate, risk-adjusted discount rate. So we'll have to work out two problems. That is, for 10% we'll have to work out, and then adjusted discount rate, ADR, is equal to 20%. So very clear. So let's understand. We know we have to take down year. Okay, then we have to take down cash flow, we have to take like PV factor, okay, and present value of cash flow. This is 10%. So we know in the problem 1 lakh rupees is your outflow. Okay, so they have not taken here 1 lakh. At the end, after I will take it separately, that is the cash outflow. Okay, here, so I've taken the cash inflow, that is 40,000, 50,000, 15,000, 30,000. Okay, so I have very written cash flow 40, 50, 15, 30. So 1 divided by 1.10, you will get 0.90. In the second year, you will get 0.826. In third year, you will get 0.758, 0.683. Multiply this cash flow A into B. If you multiply A into B, you will get these 36,000. 40,000 into 0.909, 36,360. 50,000 into 0.826, 41,300. 15,000 into 0.751, 11,265. 30,000 into 0.683, 20,490. You add it up, you will get 1,09,415. That is inflow. Okay. So we know the cash outflow is 1 lakh. If you bring this 1,09,415 and minus your 1 lakh, why we are minusing? Cash outflow. Or you can just put it in the bracket, isn't it? Then you sum it up, you will get 9,415. Is it positive? Yes, positive. Can we accept? Yes, we can accept at 10% rate. But look, this particular project is, we cannot discount at 10% because this cash inflow, this particular project which I am investing, this cash I cannot with certainty tell in the year one I will get 40,000 because I do not know what will happen tomorrow. Okay, suddenly coronavirus has come because I did not know whether this will happen. Suddenly there is a RBI monetary policy change. I will not understand. There will be suddenly an inflation. I will not understand. Okay, suddenly my board of directors or my employees, something will happen to them. Machinery will break down. Okay, there are so many factors that is involved in the future which I will not be able to predict with certainty. So therefore, what did I do? For all those risks, I added up a 10% premium and I started discounting at 20%. Okay. If I have to discount it at 20%, same my 40,000, 50,000, 15,000, and 30,000. Now 20% if I do 0.833, 0.694, 0.579, 0.482. Okay. Now if I this is AB and this is B and this is A into B, then 40,000 into 0.833, 50,000 into 0.694, 34,700, 15,000 into 0.579, 8685, 30,000 into 0.482, 14,460. Now cash inflow is 91,000, cash outflow is 1 lakh. Then if you look at here, it becomes negative. Can I accept the project? No, I cannot accept the project. Why? Because this project has a lot of risk involved. Okay. Why? Because the cash flow, I cannot with certainty tell what is the cash flow. So therefore, if I discount it at 20%, this project cannot be accepted. Okay. That is why I'm telling you the risk management in taking capital decision is one of the important factor that we need to factor in. Now, so far, I've completed what do we call it as risk adjusted discount rate method. Now, I will do the next method in my next tutorial. Okay. Till then, okay, you have to